Good morning. This is Larry McMillan with a market update on Monday, February 24th, before the market opens. So, a couple of weeks ago, we had seen that the bears had a chance to get things going. They really didn't do a whole lot with it until Friday, when things began to break down a little bit. And then tonight, or Sunday night, uh, things broke down badly as for reasons that we'll never quite know. Suddenly the coronavirus, which is obviously very serious, is now a factor in the market. It probably should have been all along. So S&P is breaking down now. The S&P futures are down about 90 points this morning, down to 3250. That breaks the first important support level at 3330, which had actually held on Friday. So we're now back to prices that we'd seen in January, back below what had been the highs at that time. And the next support level, which was the January lows, is at 3220. So if that gets taken out, then we're actually looking at the chances we could really be in a bear market and not just a correction. So things have definitely turned more bearish on the S&P chart. And that was the one thing that was lacking before. We had sell signals in other areas, but the chart itself was holding up. Put call ratios, equity only put call ratios, which we use to measure the broad market, continue to remain on sell signals. Breadth had been dancing back and forth between buy and sell, but it's definitely on the sell side of things right now. So far, new highs have continued to outpace new lows. But in a study that we did a few months ago, it turns out that the first day on the New York Stock Exchange, now not using NASDAQ or stocks only data, but New York Stock Exchange data, the first day that new lows outpace new highs is also still a time you can sell. Usually there's more to come on the downside after that. We have not had that yet, but we might get that today. The warning system that really did work on this move anyways was volatility. VIX jumped up last week and closed above 15.5, which was the level we've been looking at. But more importantly, it closed above its 200-day moving average, and the 20-day moving average of VIX also closed above the 200-day. So now VIX is in an uptrend, and it's way up this morning. It's up to about 23 right now. But as long as VIX stays in an uptrend, that's bearish for stocks, and we will be looking shortly for another VIX spike peak buy signal, but those are short-term signals within the larger bearish trend. So things overall have taken a much more negative turn. I should also mention that the the term structure of the VIX futures is now decidedly inverted, and that's also a bearish sign for the market. So we'll see how far the bears can persist with this. The 3220 level is certainly, I would think, going to be defended by the bulls. But if that gets taken out, we are definitely looking at a more serious decline materializing. So thanks for listening. It wasn't particularly wonderful news if you're long, but I think this market is tradable on both sides, and it's now the bears' turn to have the ball, the offense, for a while. I invite you to our website, optionstrategist.com, where we have daily letters and we follow all of these indicators and give daily updates on them as well as recommendations. Thanks for listening.